Okay, welcome everybody to Mrs. Royce's Accounting Lecture Series. The installment for this lesson is on accounting for sales and cash receipts. Are you ready? Okay, let's get started. As always, there's an essential question for the unit. What would the benefits be for the merchandising business that uses the accrual method to have an accounts receivable ledger? The objective is you are going to be able to, at the end of this lesson, be able to say, I can explain the relationship between the accounts receivable ledger and its controlling account. The second objective is I can record sales on accounts using the sales journal. So let's review a few terms. Put your thinking cap on. We're going to think like an accountant. What is a subsidiary ledger? Yes, a subsidiary ledger is a group of similar accounts whose combined balances equal the balance in a specific general ledger account. Now you know what next question I'm going to ask. Other than, I forgot to say this, it's often referred to as a subledger in accounting. General ledger, subledgers. So you have your general ledger is the accounts receivable. The subledgers for that are going to be the customers. Of course, I'm going to ask, what's a general ledger account? Perfect. It's an account or record used to sort and store balance sheet and income statement transactions. Now I want you to think about that. We talked about a general ledger account being in like a book with a chart of accounts in the beginning, and then each of the account of the business was represented, and we could keep track of the individual balances as we go. But if we think about it, it is used to store balance sheet and income statement transactions. This is where you store the specific account information. Again, I found an image just to show you this would be a cash ledger. We have to start thinking of, yes, we've used certain forms in this class, but there's also different electronic means and ways that you can do it. And I'm going to start introducing those so you can see those. This is a question that I really want you to think about. Do you think you can set up a subsidiary ledger for any ledger account? Think back, break the question down, and let's see what your answer is. I want you to give me 3 examples of accounts that are found in a general ledger. Now, I want you to think back to last chapter. What was the subsidiary ledger that we used? Exactly, accounts payable. Now I want you to again think like an accountant. Tell me the name of the subsidiary ledger that a merchandising business would use to keep track of the people that owe the business money. The business lets the customer pay later on account. Think very carefully before you answer the question. I know you can get it. Exactly, accounts receivable. Money that is owed us from customers who purchase our merchandise is accounts receivable. This is an image of what an accounts receivable subsidiary ledger will look like. It will contain an account for each customer. So as you can see, Wells Apartments, Skinner College, all of these people owe the business money, and it's kept in the accounts receivable ledger so that we can keep track of that. So now here's another basic recall question for you. What account classification is for accounts receivable? What is its normal balance? Perfect. asset. Accounts receivable is an asset, and it is a debit, is its normal balance. Now I want you to summarize what you've learned so far. Now that we've completed the accounting for a merchandising business when we purchase inventory so that we can sell it, how does a business then set the price of the item that we're selling to the public, to the customer? How do we do that? How does a business determine that? Well, the business decides on the amount they want to receive from the sale of an item. And that is called a selling price. So the business decides this is the amount of money that we need to get for the product that we're selling to our customers. Now, how does a business determine that? Well, of course, it's based on accounting, it's based on numbers, and it's based on money. So let's look at how they do that. You take the cost of what you paid for the merchandise, plus you decide what you want to make, which is called a markup. Makes sense. You mark up the price, and then that gives you the selling price. So let's take a look at something. Let's go back to our Walmart example from when we did when we were buying Oscar Mayer hot dogs. We bought them from Kraft Food, billed to Walmart. The invoice came in. We've got invoice terms of $210 net 30. This is from last chapter what we would have put in our vendor account because we owe Kraft Foods $3,600. Now, if you look at this, it says that we bought 90 packages, 8 packs, at 40 cents a package, and that cost us $3,600. Now, we as a business have to determine how much do we want to sell the product for. So let's say we want to sell the product for $1. That way we make 60 cents a package. That's what the markup is. The 60 cents is the markup. What we paid was the 40 cents. We marked up 60 cents. We're selling it to the customer for $1. So once again, markup is cost of the merchandise plus the markup, what we want to earn, and that equals what we sell it for. This is just a reminder that the name of the account when you sell your merchandise to customers on account, it's accounts receivable this time. So once we have given the customers credit and they're using it and they're purchasing our products and they're going to pay us at a later date, the next step in the accounts receivable process is to set up customer accounts. Last chapter, we set up a vendor account, people that we owed money. Now we have to set up customer accounts to keep track of who owes us money. As you can see from the look of it, it's Skinner College is our customer. We have a number to keep track of them, and then they have a balance. And this is what a customer account looks like. Now let's compare it to the vendor account. It's very similar. What is the one difference? Yes, you're right. The credit balance, because we owe the money out, and here they owe the money, so it's coming in, so it's a debit balance. Good job. Now, how do you think that the business keeps track of records on each customer sale and account? I want you to think about it. How would we keep track of a single record so that we can go and say, yep, this list of customers owes us money? Perfect. We use a sales journal. So let's look at the sales journal. Similar to the purchases journal, but there's going to be some differences, right? Okay, so we have the date, the account debited. What would we write here? Yes, we would. We would write the customer name. Okay. The sale number, accounts receivable debit, sales credit, because this shows that the sale is the credit. And then, of course, this interesting column here called sales tax payable credit. So what would the sales credit column tell you? And then there's also the sales tax credit right here. I want you to think about sales tax for a second. When you go to Walmart, GameStop knows, do you pay sales tax? Yes, you do. Everybody owes sales tax when they purchase something. Who collects the sales tax? Yeah, exactly. The business collects the sales tax. So if we are the business and we're collecting thousands of dollars from our customers, what type of account classification do you think sales tax is? We're collecting it in, and we're going to have to pay it out. Pay it out to who? The government, of course. So, how do we keep track of sales tax? It's the sales tax payable account. It is a liability account because we're holding that money for the government until we give it to them. So we have our sales account, where we made our sales, and then we charge separately for tax. So if you buy something for $1 and it's 6% sales tax, that 6 cents has to go into a separate account. Sales tax payable account. And then when you pay the government, it takes care of it. So I want you to think about those things. So it is the business's responsibility to collect the tax money. If you look at a sales invoice, which last chapter we did purchases, right? We got the invoice in because we owed the money. Now we're going to be sending the invoice out to our customers. So 3 Green is sending a sales invoice to Wells Apartments. They've purchased this amount of stuff from us. Here's the sales tax, and here's the total. So what would this transaction look like? Well, let's take a look. If on November 4th, which is the date right here, we sold merchandise on accounts to Wells Apartments for a total of $454.50. So those are our actual sales. That's the amount of merchandise that we sold them. Well, plus the sales tax, because the government gets their piece. So our total invoice is the $481.77. So how do you think that we're going to journal that or put it in a T account to explain that entry? You are going to do an accounts receivable debit for the total amount of money plus the sales tax. Why? Because we have to collect it. Okay? But we cannot include this total amount in our sales because what was our sales? Yes, our sales is the subtotal, the $454.50. That's what we put in our sales account to keep track of the inventory that we've sold. And then sales tax is put into a separate account. Sales tax payable credit. It is a credit because it is a payable. You take what we sold plus the sales tax, and that will equal what's in the accounts receivable account. Because whether we get to keep the sales tax or not, in accounting in the initial thing, you have got to put that all in accounts receivable because that total amount of $481.77 is owed to us. Now, whether we get to keep the whole thing, that's another accounting for another day. But this is how you do the accounting to receive sales tax. And that's it. I hope that you did good on the ED puzzle quiz. I can't wait to see the results. This chapter should go really well. It's just a flip of what we did before. And I will see you soon.